Are you wondering how the Federal Reserve's decisions impact your ability to buy or sell a home? As interest rates shift, mortgage costs, housing demand, and even foreign investment are all on the line, stay tuned to see how it affects you. The Fed's policies keep the U.S. economy strong, but rising interest rates are driving up mortgage costs and reducing housing affordability. Consequences of COVID's impact: the Fed raised rates to over 5%, making mortgages costly and housing less affordable. By mid-2024, talks of lowering rates emerged, which could reduce mortgage costs and boost housing demand. 2. The real estate demand changes in the Fed's interest rates also affect mortgage-backed securities, MBS. When rates rise, demand for MBS declines, leading to tighter lending standards and higher mortgage rates. This can reduce housing affordability and limit buyer access to loans, particularly for first-time buyers. If the Fed cuts rates, lending could ease, boosting housing demand as more people qualify for mortgages. 3. The Fed's role in housing stability. The U.S. dollar's dominance influences the Fed during crises, helping stabilize markets, including real estate. For instance, during the pandemic, the Fed's swap lines provided liquidity to foreign central banks, stabilizing global markets and preventing major disruptions. This global stabilization supported investor confidence and prevented sharper downturns in U.S. housing markets. 4. Local market trends and housing. As the Federal Reserve adjusts interest rates, local housing markets across the U.S. feel the impact. When rates rise, mortgage costs increase, making it harder for buyers to afford homes. This often slows down previously hot markets, particularly in cities like New York and San Francisco, and accelerates the trend of people relocating to more affordable states like Texas and Florida. These states, which have seen a surge in demand, may experience further price increases as buyers flock to areas with lower living costs and more housing availability. On the other hand, if the Fed lowers rates, mortgage affordability improves, leading to increased demand in markets where relocation is booming, such as Texas and Florida. In conclusion, the Fed's policies, driven by market-leading innovation in the industry, continue to shape housing markets across the country, with Texas and Florida likely to grow further. Buyers and sellers should watch interest rate changes closely to gauge how mortgage costs and housing prices will be affected. Thanks for watching. The Federal Reserve's decisions will continue to shape housing markets, especially in states like Texas and Florida. Stay tuned for more updates on how this impacts you. Don't forget to like, subscribe, and hit the bell for future insights.